Support and resistance are two more building blocks of the technical arsenal. In their classic book, Technical Analysis of Stock Trends, Edwards and McGee define support as buying, actual or potential, sufficient in volume to hold a downtrend in prices for an appreciable period, and resistance as selling, actual or potential, sufficient in volume to satisfy all bids and hence stop prices from going higher for a time. A support zone represents a concentration of demand, and a resistance zone a concentration of supply. The word concentration is emphasized because supply and demand are always in balance. But it's the relative enthusiasm of buyers over sellers or vice versa which is important, because that's what determines price trends. If buyers are more enthusiastic than sellers, they'll continually increase their bids until their purchasing demands have been satisfied. On the other hand, if sellers are the more anxious, then they will be willing to liquidate at lower prices, and the general level will fall. If in doubt, think of support as a temporary floor for prices and resistance as a ceiling. At the outset, I think it's important to emphasize that support and resistance areas are not predictors of where prices will reverse, but merely indicate possible or probable points. At the beginning of this diagram, the price is declining. It finds a bottom at A and then moves up. The next time it falls to A, it again rallies. So A may now be said to be a support area. This establishes our first principle of support-resistance analysis, that a previous high or low is a potential resistance or support level. The third time the price slips to A, it goes through, or as we say, violates support. As we progress, the price finds temporary support at B. As the price works its way lower, C also proves to be a support point. But note, the rallies are reversed at this brown line, which is an extension of the green support line at level B. That brown line now marks a resistance zone. Thus the second principle is that support reverses its role to resistance on the way back up. Just think of it this way. A floor in a building acts as a support zone, but when you fall through it, the floor now becomes resistance, otherwise known as a ceiling. The reason why support and resistance reverse their roles can be appreciated by an explanation of some elementary psychology. No one likes to take a loss, and while some overcome this feeling by cutting losses at an early stage, others hold on until the price comes back to where they originally bought the security in question. At that point, they're able to break even and sell, thereby creating a quantity of supply sufficient to temporarily halt the advance. Finally, we see the price rally through resistance at B. So where's the next level of resistance likely to be? The next level of previous support, perhaps? As you can see, that's exactly what happened. After a brief consolidation, the price rallies through this resistance, but the subsequent decline then finds support at A again. Thus our third principle is that resistance reverses its role to support on the way down. Now let's establish some simple rules for assessing where potential support resistance areas might develop. Rules for determining the potential support resistance points. 1. Previous highs and lows. We've already discovered that previous highs and lows offer potential support and resistance areas. Highs are important because many market participants may have bought close to or at the actual high for a move. When prices decline, the normal human response is not to take a loss but to hold on. That way, it's internalized, there won't be any pain of actually realizing a loss. Consequently, when the price returns to the old high, there's a strong motivation to break even, so sellers begin to liquidate. Also, those who bought at lower prices have a tendency to take profits at the old high, since that's the top of familiar ground. By the same token, any prices above the old high look expensive to potential buyers. Consequently, there's less enthusiasm on their part, so they begin to pull away from the market. When a price rallies and then falls back to the previous low, these bargain basement prices appeal to potential buyers. After all, they missed the opportunity the first time prices retreated to this level, and are therefore thankful for another chance. For the same reason, sellers are reluctant to part with their securities as prices approach the previous low, since they saw them bounce before, and naturally wonder why the same process should not be repeated. This chart shows General Electric. Note these highs developed at around the same level as the previous one, and this low formed at the same reading as that of July 2010. You may think this bottom here was random in nature, but the next time the price fell to this vicinity, it clearly found temporary support there. These arrows show highs and lows where pivotal points, by which I mean support and resistance levels, did not develop. And that's a reminder that former highs and lows are merely intelligent places for expecting a temporary interruption in the trend. They are certainly not guarantees. 2. Support and resistance zones have a habit of forming at round numbers. This is probably because numbers such as 10, 50, or 100 represent easy psychological points upon which traders and investors often base their decisions. In the 1970s, for example, the Dow Jones Industrials had a great deal of difficulty surpassing the 1,000 level. For gold in the 1980s and 1990s, the magic number was $400, and so forth. The guide for potential turning points, then, is to look for round numbers. 3. Emotional points on a chart represent potential support and resistance levels. There are many examples of emotional points on a chart, but gaps are probably the most obvious. They're formed when buyers and sellers respond so emotionally over news that a blank space or gap is left on the chart. Gaps develop on bar charts, but not on point and figure or close only. When they appear in candlestick charts, they're known as windows. In pretty well all instances, gaps are said to be closed as emotions return to their starting point and prices retrace this open ground. It's the upper and lower area of gaps that becomes potential support and resistance points. Unfortunately, there's no technique for forecasting when a gap will be closed. The vast majority are, but don't get any ideas because there are a couple on the Dow that were established in the 1930s and that have never been closed. In this chart, we see a gap that developed in October 2010, where the subsequent November rally found resistance. Then, in January 2011, a large gap was filled, but the decline in March was halted at the support level. Finally, the February gap up here was quickly filled, and the rally that did it was halted at the gap opening. 4. Proportionate moves and retracements. The law of motion states that for every action there's a reaction. Price trends established in financial markets are really the measurement of crowd psychology in motion, and are also subject to this law. These swings in sentiment often show up as proportionate price moves. Perhaps the best-known principle of proportion is the 50% rule. For example, many bear markets, as measured by the Dow, have cut prices in half. As examples, the 1901, 1903, 1907, 1919 to 21, and 1937 to 38 bear markets all recorded declines of 46, 49, 47, and 50% respectively. By the same token, rising markets often find resistance after doubling from a low. The first rally from 40 to 81 in the 1932-37 bull market was a double. In effect, the 50% mark falls halfway between the one-third to two-third retracement described earlier in the discussion of peak-trough progression. These 1 and 2/3 proportions can be widely observed in all securities and also serve as support or resistance zones. Ratio scale charts are helpful in determining such points, since moves of identical proportion can easily be projected up and down. Moreover, these swings occur with sufficient consistency to offer possible reversal points at both peaks and troughs. Remember, technical analysis deals with probabilities, which means that forecasts using this method in isolation should not be made. This chart of Dollar General shows an example using 1/3, 2/3, and 50% retracements. In this instance, the brown line represents 100% of the move. If we want to establish possible resistance points for subsequent rebounds, then the intelligent places to monitor are the 1/3, 2/3, and 50% retracements. As you can see, this rally ended at a 50% retracement, and this one at a 66% or 2/3 retracement. Many technicians use a sequence of numbers discovered by Leonardo Fibonacci, a 13th century Italian mathematician. The sequence has many properties, but a key one is that each number in the sequence is 61.8% of the next number, and 38.2% of the previous number, and so forth. Once again, this decline represents 100% of the move, so a rally back to this line represents a 61.8% retracement, which is where these rallies found resistance. Although it was not known at the time, note how this initial decline stopped at 61.8%. However, this one was known, and it held at the 50% level. As you can gather, this is not a precise science, as sometimes a level is resistance on the way up, at other times support on the way down, and at still others of no significance whatsoever. Support resistance, then, is a basic building block concept, and it's best used in conjunction with other indicators and approaches. There's a fifth rule for establishing potential support resistance levels, and that relates to the fact that trend lines and reliable moving averages are nothing more or less than dynamic support resistance areas. Dynamic because they're continually moving, as opposed to round numbers, for instance, which are static. I'll have more to say on that as we approach the subjects of trendline and moving average analysis. At this point, you're probably asking the question, how do I know how important each support and resistance level is likely to be? Unfortunately, there's no hard and fast answer, but there are some general rules that can act as guidelines. 1. The amount of a security that changes hands in a specific area. The greater the activity, the more significant the zone. This is fairly evident, for whenever you've had a large number of people buying or selling at a particular price, they have a tendency to remember their own experiences. Buyers, as we have already established, like to break even. Sellers, on the other hand, may have bought lower down and recall that prices previously stalled at the resistance level. Their motivation for profit-taking becomes that much greater. 2. The greater the speed and extent of the previous move, the more significant a support or resistance zone is likely to be. The attempt to climb through the resistance level here can be compared to the efforts of a person who tries to crash through a door. If he attacks the door from, say, 10 or 12 feet away, he can propel himself with lots of momentum, and the door will probably give way. On the other hand, if he begins his attempt from 100 feet away, he'll arrive at the door with less velocity, and probably fail in his attempt. In both cases, the door represented the exact same resistance, but it was the resistance relative to the velocity of the person that was important. The same principle can be applied to the market, in that a long, steep climb in price is similar to the 100-foot run, and the resistance level resembles the door. Consequently, the more overextended the previous price swing, the less resistance or support that's required to halt it. 3. The greater the amount of time that's elapsed since the formation of the original congestion, the less important a specific zone is likely to be. A supply which is 6 months old has greater potency than one established 10 or 20 years previously. Even so, it's almost uncanny how support and resistance levels repeat their effectiveness time and time again, even when separated by many years. Summary. 1. Support and resistance represent a concentration of demand and supply sufficient to hold a price move at least temporarily. 2. They're not signals to buy or sell, but intelligent places for anticipating a reversal. They should always be used in conjunction with other indicators. 3. Potential support and resistance zones develop at previous highs and lows, round numbers, trend lines and moving averages, emotional points on the charts, and retracement points such as Fibonacci proportions. 4. The significance of a support-resistance zone depends on the amount of an asset that previously changed hands in that area, the speed and the extent of the previous price move, and the period of time that's elapsed since the zone was last encountered.